My name is Chris Webb. I'm the president of the Lake Forest Lake Bluff Rotary Club. We want to welcome everyone here this morning. Our meetings on Wednesday mornings normally aren't quite this crowded, but we're hoping, hopefully one day they will be. We start with the Pledge of Allegiance, so please stand. John Luby is going to do the invocation.
Dear Lord, thank you for bringing us together today in the spirit of Rotary. And we ask that you help us live the four-way test in our life, in our business, and with our families in sharing the good times we have together. We ask you to take care of the military as they preserve our freedoms around the world. Please also take care of the family that lost their child this week in Lake Forest. And Lord, it's been a wonderful run on this wonderful weather. Please hold the snow off as long as possible. Amen.
Thanks again for coming. If I make any mistakes up here, I'm still a little damaged. I was at the BCS game Monday night, and I was an LSU fan, so I'm kind of recovering. I'm in recovery mode currently. I'd like to introduce a couple of our special guests here. Obviously, Dr. Charlie Evans, who's going to be speaking. We also have State Senator Susan Garrett here with us this morning. You want to stand up? The President of the Lake Forest Hospital Board, Forrest Whitaker. President of Lake Forest College, Steve Scott. The head of the Economics Department of Lake Forest College, Rob Lemke. And a candidate for Lake County Board, Mike Rummel, former Mayor Mike Rummel. We'd also like to thank our member Bob Kinahan for putting the program together on your table. He printed those for us, and we appreciate that. Also, I want to thank Lake Forest Club for the flexibility of putting this together at such short notice. We are not used to having this many people here on Wednesday mornings. So thank you to Scott Bruce, the General Manager of Lake Forest Club. So now I'd like to introduce Charlie Evans. He is the President and CEO of the Federal Reserve Bank of Chicago. Just a little background on the Federal Reserve. The Federal Reserve Bank of Chicago is one of 12 regional reserve banks across the country. These 12 banks, along with the Board of Governors in Washington, make up our nation's central bank. As head of the Chicago Fed, Charlie oversees the work of roughly 1,300 employees in Chicago and Detroit who conduct economic research, supervise financial institutions, and provide payment services to commercial banks and the U.S. government. He also serves on the Federal Reserve, or Federal Open Market Committee, which formulates national monetary policy. Before becoming president, Charlie, as he likes to be known as, served as director of research, managing the study of monetary policy, financial markets, regional economic issues, and banking. His academic background involves teaching at the University of Chicago and the University of Michigan. He has a bachelor's degree in economics from the University of Virginia and a doctorate from Carnegie Mellon University in Pittsburgh. In many ways, his career has served as preparation for his current responsibility, helping make monetary policy decisions that are in the best interest of the U.S. and the economy and the American people. So with no further ado, I'd like to introduce Charlie Evans.
All right, thanks, Chris, for that great introduction, and special thanks to Tim Newman for arranging today's event. This seems to be the time of year when both businesses and individuals focus on planning for the year ahead. I'm delighted to be here this morning to share my perspective on the current economy, and in doing so, I will discuss my views of the progress of the recovery and on the likely course of monetary policy. Those of you who follow monetary policy developments may be aware that I was the only dissenter at the last two policy meetings, so it should come as no surprise when I say that the views I'm expressing today are my own, and not necessarily those of the Federal Open Market Committee or my other colleagues in the Federal Reserve System. Lately, it has become extremely important for Federal Reserve policymakers to get out from behind, which was this one? It's become extremely important for Federal Reserve policymakers to get out from behind our desks and into the communities we serve. Doing this gives me the opportunity to explain how I think about the economy, but it's also important for me to learn from questions and comments like the one we had just a few minutes ago about health care and insurance. I really do value the opportunity to interact with business people within our Fed district. That comprises most of the Midwest and stretches from Detroit to Des Moines and on down to Indianapolis. So it's really a pleasure to be here today. Thanks so much. Today I'm going to discuss the outlook and then offer my views on policy. 4 years ago, the U.S. economy entered what developed into the deepest downturn since the Great Depression. Indeed, many are now referring to 2008 and 2009 as the Great Recession. During recoveries from severe recessions, we usually see solid job and output growth, with the improvements in one fostering gains in the other. We're not seeing this today. It's now 2.5 years since the Great Recession ended and the recovery began. Yet despite both accommodative monetary policy and fiscal stimulus, the pace of improvement has been painstakingly slow. Real gross domestic product is only just back to where it stood at its pre-recession peak. Employment growth is barely enough to keep pace with the natural growth in the labor force, and the unemployment rate remains extraordinarily high. However, recent news about the performance of the economy has been more promising. Motor vehicle sales have returned to their upward trend following supply disruptions caused by last spring's horrible Japanese tsunami. U.S. manufacturing is expanding, boosted by the recovery in the automotive sector, as well as growing worldwide demand for materials and equipment in the energy, mining, and agricultural sectors. Consumer spending outside of autos appears to be rising at a moderate pace, and employment growth, although still tepid, is showing signs of improvement. Initial unemployment insurance claims are down, and layoffs have fallen, contributing to a decline in the unemployment rate of 0.5 percentage point over the last quarter. So the economy is looking somewhat better than it did a few months ago. But this does not mean we are seeing a massive surge in economic activity. The data shows only modest improvement in growth to rates that are near or just somewhat above the economy's longer-run potential. Periodically, the FOMC publishes participants' projections for several key economic variables. Our latest forecasts were made in early November. Our outlook then was for real GDP growth to be around 1.75% in 2011, and then rise to 2.75% this year in 2012. Though an improvement, this 2012 pace is not far above most analysts' views of the potential rate of output growth for the economy. Thus, such growth rates are not strong enough to make much of a dent in the unemployment rate and other measures of resource slack. Indeed, the FOMC's latest forecasts are for the unemployment rate to remain above 8.5% through this year and to fall only to about 8% in 2013. Now, the unemployment rate recently dropped surprisingly by quite a bit, and we're at 8.5% now. I would be pleased to be proved wrong with regard to my unemployment rate forecast and have it continue down much more briskly. As I just noted, the somewhat firmer tone of recent economic data suggests some welcome traction, but the data are not strong enough or uniform enough to assert that momentum for growth is building. The headwinds that we face are still substantial. Moreover, the problems in Europe now loom larger. Careful analysis suggests that the direct impact of slower European growth on U.S. net exports likely would be small. However, there is a substantial risk that substantial financial disruptions in Europe could impinge on the cost and availability of credit in the U.S. or induce a new wave of cautious behavior by households and businesses. If that were to occur, then we could see a larger adverse impact on economic activity in the U.S. After considering all of these factors, my outlook today for real GDP growth remains largely unchanged from the November forecast, and my forecast for the unemployment rate is only slightly lower. Indeed, I continue to be concerned about downside risk to growth. Now, what about inflation? Large increases in energy prices pushed headline PCE inflation up from about 1.25% last fall to almost 3% this summer. One-time events that were well beyond the control of monetary policy, such as the Arab Spring protests, drove oil prices higher and took a bite out of households' budgets, but they did not result in a permanent ratcheting up of inflation. Prices for energy and many other commodities have softened of late, and the earlier increases did not pass much into core inflation. Notably, recent numbers show core inflation is now lower than last summer. Now keep in mind, core inflation is a better predictor of future overall inflation than total inflation is. And with the unemployment rate still high and capacity utilization low, resource slack will continue to exert downward pressure on prices. In addition, measures of longer-run inflation expectations are at the low end of the range they've been running since last November. Putting these factors together, I would argue that the outlook for inflation is likely to remain low for the foreseeable future. The November FOMC forecasts for core inflation in 2012 were concentrated near 1.8%, and the forecast for total inflation in 2013 and 2014 were in the range of 1.5% to 2%. My own assessment is that inflation will be at the lower end of these ranges. So now recall that the Federal Reserve has a dual mandate for providing monetary and financial conditions to support maximum employment and price stability. Given the high unemployment rate and low job growth, I think it's clear that the Fed has fallen short in achieving its goal of maximum employment. As for the price stability component of our dual mandate, the majority of FOMC participants, including myself, judge that our objective is for overall inflation to average 2% over the medium term. That's our objective. With my own view that inflation is likely to run below this rate over the next few years, I believe we're going to miss on our inflation objective as well on the low side. So, what's the right course for policy? The traditional course of action, when inflation is below target and real output is expected to be below potential, is to run an accommodative monetary policy. I support such accommodation today, and I believe the degree of accommodation should be substantial. I believe that the disappointingly slow growth and continued high unemployment that we confront today reflects the fact that we are in what economists call a liquidity trap. Short-term, risk-free nominal interest rates are close to zero, and actual real rates are modestly negative, but they are still not low enough to return economic activity to its potential. A liquidity trap presents a clear and present danger of a prolonged period of economic weakness. Today, that means a risk of repeating the experience of the United States in the 1930s or that of Japan over the last 20 years. But we need not resign ourselves to such an outcome. Many economic studies conclude that economic performance can be vastly improved by employing monetary policies that commit to keeping short-term rates low for a prolonged period of time. As I weigh the evidence, I believe that we are in a liquidity trap, and that calls for continued accommodation. But I recognize that I could be wrong in this assessment. Instead of a liquidity trap, some have posited that we are in an economic malaise that reflects structural factors. Perhaps the economy today is actually functioning close to a new, more dismal productive capacity. I've discussed this very pessimistic structural impediment scenario in other forums. If this dismal scenario is true, then further monetary accommodation will only lead to rising inflation without much improvement in unemployment. Those subscribing to this dismal view warn of repeating the mistakes of the 1970s. At that time, the Fed did not understand that the changing structure of the economy had caused the natural rate of unemployment to rise. Too much accommodation during that time, in order to lower unemployment, which it couldn't do, only served to raise inflation and inflation expectations. Even though I do not find this structural impediment scenario compelling myself, as a prudent policymaker, I must at least consider its possibility. Without a more definitive picture of whether we are in the midst of a structural change or a liquidity trap, I favor a monetary policy strategy that protects against both risks: dismally slow growth on the one hand and rising inflation on the other. So let me outline how this balanced policy approach might work in practice. The Fed can sharpen its forward guidance by pledging to keep policy rates near zero until one of two events occurs. First, this policy would account for the liquidity trap risk by communicating that we intend to keep the federal funds rate at exceptionally low levels as long as the unemployment rate is above a 7% threshold. Reductions in the unemployment rate below this level would represent meaningful progress towards the natural rate of unemployment and might be a reason at that time to lessen policy accommodation because we were well on the right track to getting back to where we were before. Second, this policy would account for the risk of higher inflation, that is, we would be committed to pulling back on accommodation, if inflation rises above a particular threshold. I would argue that this policy's inflation safeguard threshold needs to be above our current 2% inflation objective. My preferred threshold is a forecast of 3% over the medium term. So as long as the unemployment rate is above 7%, we would have accommodated policy. But if inflation were to rise up to 3% and it was expected to be 3% over the next 3 years, the medium term, that would indicate that things weren't going the way they were supposed to. The other scenario seems to be more likely. Let me emphasize that under this policy proposal, core inflation reaching 3% is only a risk, not a certainty. Indeed, simulations of standard economic models suggest that core inflation is likely to remain below 3%, even under a policy of extended monetary accommodation like the one I've described. But the economy may behave differently than I expect. Still, 3% inflation is a risk that we should be willing to accept. If, contrary to most evidence, the natural rate of unemployment is higher than 7%, then under this policy, inflation will rise more quickly and without any improvements to the real side of the economy. In such an adverse situation, the inflation safeguard triggers an exit from what would be evidently excessive policy accommodation. It would do so before inflation expectations would be in much danger of becoming unhinged. We would not have the desired reductions in unemployment, but then again, there wouldn't be anything that monetary policy could do about it. We would suffer some policy loss in that a 3% inflation rate is above our 2% target, but we certainly have experienced inflation rates near 3% in the recent past and have weathered them well. And 3% would not unhinge long-run inflation expectations, particularly when everybody understands that our long-run goal is to keep prices stable, and that's associated with a 2% target. We're not talking about anything close to the debilitating higher inflation rates we saw in the 1970s or the early 1980s. Most importantly, we would also know that we had made our best effort. But let me be clear. There's a natural tendency for policymakers to pull back on accommodation too early before the real rate of interest has fallen to low enough levels to get the economy moving. Such errors happened in 1937 when the Fed prematurely withdrew accommodation. This was documented by Milton Friedman and Anna Schwartz. More recently, the Bank of Japan made the same mistake. Therefore, I think it's essential that the Fed clearly commit to a policy action that is measurable against our dual mandate goals. Now, regardless of whether such explicit forward guidance is adopted, the effectiveness of monetary policy can be enhanced by clear communication of the Fed's ultimate goals and of the strategies that it will use to achieve these goals. The minutes from the December FOMC meeting, which were released last Tuesday, noted that the committee discussed two initiatives to enhance our communications about monetary policy. Let me tell you about those. First, we agreed to begin publishing participants' projections for the appropriate path for the federal funds rate, and qualitative information about their outlooks for the Fed's balance sheet in our quarterly summary of economic projections. Second, we discussed formulating a consensus statement on the committee's longer-run goals and monetary policy strategies. Until now, participants have provided, now when I say participants, there are currently 17 of us. There are the 12 Reserve Bank presidents who go to Washington to participate with the FOMC meeting, and there are currently 5 governors. There should be 7, but there are currently 5 governors. Until now, participants have provided forecasts for real GDP growth, the unemployment rate, and inflation, but not the policy assumptions that underlie those projections. The forecasts were made under each participant's unspecified views of appropriate policy, which is defined in true Fed speak in the following way. We were asked to put together a forecast for these variables. You have to make an assumption about what the environment's going to be. Part of that is, what's policy going to be over that environment? So we all had to think about that ourselves. And our guidance was, the future path of policy, you should assume the future path of policy that each participant deems most likely to foster outcomes for economic activity and inflation that best satisfy his or her interpretation of the Federal Reserve's dual objectives of maximum sustainable employment and stable prices. So we were supposed to assume appropriate policy to meet what we were supposed to achieve, but we didn't have to write it down. It's good. Tittering. I'll take that back. When I spoke to people in public, there was tittering over that. Being more explicit about appropriate policy can clear up a lot of uncertainty. For example, suppose inflation was running higher than we would like, and the economic projections in the survey showed it coming down over the next couple of years. So imagine that it's running at 3%, but the FOMC dictates, look, it's coming down to 2%. In the absence of information about participants' policy projections, the public would not know whether the FOMC thought inflation would simply come down on its own, or whether it thought that a monetary tightening would be required to reduce inflationary pressures. Including policy projections will help clarify such judgments for the public. In my opinion, this is a substantial first-order improvement in policy communications, and this greater clarity may have significant additional value for improving how the economy operates. Now, the second new communications initiative, a more explicit consensus framework for conducting monetary policy, is still a work in progress. Thus, I can only talk about it in generalities and give you my personal views about what it should say and why it would be very helpful. We're intending to talk more about this at our January meeting. In my view, a framework statement should help clarify what the dual mandate goals of maximum employment and price stability mean in terms of measurable economic outcomes. It should also convey the extent to which monetary policy can be expected to deliver particular long-run outcomes. And it should better enable the public to form expectations about how policy will react to economic disturbances that move employment and inflation away from levels which are consistent with the dual mandate. As I noted earlier, our goals of maximum employment and price stability usually are not in conflict, but when they are, a more explicit framework about how we go about doing our business can provide a better idea of how the committee will weigh the relative costs and benefits that enter this more difficult decision-making process. I have strongly supported the publication of our policy projections, and I strongly support the adoption of a more explicit consensus framework statement. In my opinion, my current policy views that I described earlier and prescriptions continue to be appropriate in light of these new communications vehicles. The threshold policy I discussed earlier advocates keeping the federal funds rate near zero until the unemployment rate falls below 7%, at least, or until medium-term inflation breaches 3%. The FOMC's adoption of an explicit policy framework can underscore the distinction between these policy thresholds versus our longer-run objectives. In particular, we would convey that the longer-run sustainable rate of unemployment is substantially lower than the threshold of 7%, while the inflation threshold of 3% is higher than the longer-run inflation objective. Consequently, even if inflation runs somewhat above its goal for a while, the public would understand that we intend to bring inflation down to the goal over time, and hence longer-run inflation expectations would remain firmly anchored. The communication of policy projections also works well in conjunction with these thresholds. By publishing projections for future short-term interest rates, along with unemployment and inflation, the public can evaluate the committee's thinking about which combinations of unemployment and inflation will likely lead to a liftoff of policy rates. We're currently at about 0. The August FOMC statement said that this is likely to continue until at least mid-2013, according to economic conditions that we expect. Perhaps it would be later. How does anybody know? We'll provide projections which will give you an idea of what the dates of that liftoff beyond 2013 or earlier would be. In comparing these projections against my thresholds, the public can evaluate how much more policy accommodation could potentially be allowed under my threshold proposal. Providing these additional forecasts enhances transparency and the public's ability to evaluate current monetary policy with alternative approaches, and a framework that explicitly clarifies the committee's commitment to both price stability and achievable real-side mandate responsibilities will, I believe, often allow monetary policy to respond more strongly in the medium term when adverse economic shocks impede growth and employment. Indeed, I think these additional communications vehicles can provide further clarification and increase the effectiveness of the types of additional accommodation that I have advocated in recent months, as well as the ones I advocated earlier in 2010. I've been at this for a while. Consequently, I am an enthusiastic supporter of these enhancements to Fed transparency. Now let me conclude by saying that I do not see these enhanced communications vehicles as being inherently hawkish or dovish, if you're familiar with those Fed characterizations. Participants may well have differing views on the appropriate stance of monetary policy in the particular economic circumstances of the moment. In being more explicit about our framework, we would not eliminate these differences of opinion, but we would further discipline the parameters of our discussions and clarify the judgments that ultimately lie behind our policy decisions. As the central bank in a democratic society, the Federal Reserve has an obligation to articulate what it is trying to achieve with monetary policy. I believe that these latest communications efforts are an important step in further increasing such accountability to the public. The committee equally respects both legs of the dual mandate, and I feel that these communications enhancements will help articulate the ways in which we will seek to achieve both objectives. Thank you very much, and I look forward to your questions. Okay, we didn't discuss there are microphones, and I've been instructed to go both ways with this. So over here I see a gentleman with his hand. Somebody with a microphone right away? I'll come back over here.
Yeah.
Go right ahead.
Yeah, thanks. You started your speech talking about the experience with this downturn versus past ones, whether it was the Great Depression, the 70s, et cetera. We've also heard a lot of commentators talk about, well, what's different? And whether it's demographics that are different now, whether it's the balance between supply and demand, et cetera. From your perspective, what's sort of on the top of your list in terms of what's different about the macroeconomic environment now versus past experiences?
Yeah, that's a good question. I'm not quite sure if the microphone was loud enough for everybody to understand that. The question was sort of like, what's really different about the current downturn as opposed to past downturns? And I would say that, so first off, the observation is the most recent downturn was horrific in its size. Why was that the case? Well, to some extent, we were recovering from a housing boom where we had overbuilt the housing stock in the U.S. And so housing, which had contributed strongly to the recovery in the years before that, was then declining very strongly. In trying to think about the recovery after the 81-82 recession, which was very deep, there was a very quick recovery at that time. In part it was because manufacturing employment was really under different circumstances. Workers were laid off, it was transitory, they were brought back, things were still pretty good, and they sort of got back in a V-shaped recovery pattern. In the last 3 recessions now, we've had a different type of employment arrangement with employers where workers, it's not really the temporary layoff, it's really more the permanent layoff, and we've just had a struggle to get that job loss back. We probably had more hours of the remaining workers. It's sort of the hours versus the worker type of thing. I had put together forecasts with my staff where we thought that we would have a stronger recovery than what we've seen. We did that with the full knowledge that housing was not going to contribute strongly during this recovery, but we thought somehow other sectors would contribute more strongly. Hasn't been the case. So I think I was fooling myself when I thought we could do as much without housing contributing to this. I think we need to make important improvements in the housing situation, deal with underwater mortgages, mortgage foreclosures, we need to get that situation so that houses can be sold, valuations can be appropriate, and get things moving up. The other thing which is quite different with this past recession is the amount of debt that had been accumulated, the amount of financial distress that has taken place during this. Ken Rogoff and Carmen Reinhart have written about this, and economies that experience downturns that are accompanied by banking and financial crisis, the downturns are that much larger and they're very long in their recovery. There's nothing that guarantees that those recoveries have to be very long. What the evidence says is policies that have been tried to deal with that haven't been effective, but that doesn't say that no policy could be effective. There's no theorem that says that. That's one reason why I continue to advocate for more accommodation. So did we get the microphone over here?
There. Yeah, thanks for being here. This is great. Question for you. You referred a lot to the dual mandate of the Fed, that you have 2 missions. You're supposed to keep prices stable and you're supposed to maximize employment. If you were given singular power to rewrite the mission statement for the Fed, would you keep both of those mandates? I know for most of the history of the Fed, maximum employment was not one of the missions. Would you keep both of those? Would you add something to it? Would you take one away?
Yeah, that's a great question. So as an economist, as a monetary economist by training, I am well aware of our best thinking on this, that monetary policy, through essentially printing pieces of paper, we don't create real tangible wealth in the economy that translates into equipment and structures, expands the productive capabilities. It's through the better financing of everything that we help facilitate that. That type of thinking leads you to believe that there's nothing that we can do to increase long-run growth or to reduce long-run unemployment. If the long-run unemployment rate is 5%, if it's 8%, if the structure of the labor market dictates that the long-run unemployment rate is some number as large as 8%, monetary policy could not do anything to improve upon that circumstance. However, we could generate inflation. I talked about that during the speech. So we have to be very careful about that. I think that, so with that type of training, I previously was inclined to sort of say, well, a single mandate where we focus on price stability will help position the economy so that monetary policy doesn't get in the way of the private sector that's doing a good job of efficiently allocating resources, and that's the best way to generate wealth and employment. However, I think that looking more carefully at the activities of central banks throughout history is that they've always paid attention to real economic activity, in part because it gives you important clues as to where inflation's going, but also because it's very important because when you have extraordinarily adverse downside shocks to the economy, it could take you down into deflationary circumstances, and you want to avoid that at all costs. So I think that we have benefited by having a dual mandate, by focusing on the real side of the economy. I think that we're able to maintain, we can credibly maintain commitment to price stability, that over the appropriate time horizon, medium to longer term, we can achieve 2% inflation. We can vary around that in a reasonable fashion, and the economy performs very well. But by having that additional focus on price stability, it allows us to respond to the state of the economy if there's inadequate demand, if unemployment is high because of cyclical factors, because there's greater uncertainty, but the uncertainty is over whether or not customers will walk through the door. If we can help reduce that uncertainty and get more spending going, we can get a virtuous cycle brewing and get the economy going. That would be good for inflation as well. I should alternate over here wherever the microphones are.
Hi. Once the U.S. economy reaches a normalized growth path, how do you think the Fed should manage its balance sheet so as to avoid sinking back into a recession or returning to galloping inflation?
When we began this crisis, in August of 2007, the size of our balance sheet was about $800 billion. We're at somewhere in the neighborhood of $2.75 trillion now. That's through all the accommodative policies that we have in place. At the outset, there were a number of commentators who looked very critically at the size of our balance sheet. That's a very large increase in the monetary base. Immediately extrapolated that there'd be a big increase in prices, explosive, and that would be one of the concerns that you're alluding to. We've not seen that, because that type of analysis presumes that the demand for money is stable. That's the monetarist approach to thinking about that. But in fact, the demand for money has been anything but stable. People have intensely desired safe assets, and the central banks around the world have attempted to provide a greater supply of safe assets in order to meet that extreme conservatism on the part of investors in order to keep things going. I think that once the economy starts growing very strongly, when we get out of the position that we're in right now, when the unemployment rate is down to a more reasonable place and the momentum of the economy is self-sustaining and it gets us going. Remember, when we talked about the fiscal stimulus back in 2009, the plan was public spending, which in about a year and a half, hands over to the private sector the additional spending and stimulus that the private market will achieve. We haven't gotten that. And because we haven't gotten that, we've got more of a hole in terms of demand that we would like. When we get to that point where it is self-sustaining, monetary policy would clearly want to back up from its excessively large balance sheet to something more appropriate with our inflation objectives and the conduct of future monetary policy. The economy and the needs of the economy are stronger than the $800 billion size that we had in 2007. I would anticipate a larger balance sheet than that, but it would be well south of the current $2.75 trillion. Over here, I think bringing the microphone deeper. Okay, all right, and then bringing the microphone deeper in would be a fair way to do this.
Charlie, one of the other key roles of the Federal Reserve is that of a regulator of the financial institutions. Every time I read a financial report from one of the banks, you see very low levels of loan growth, ongoing discussions of how do we meet changing capital requirements. I wonder whether or not, in fact, the regulatory arm of the Federal Reserve is perhaps impeding loan growth by virtue of the regulatory regime that's underway and the changing standards.
Yeah. So that's a terribly important issue that we need to think about. And I just want to point out sort of that we're at a point in the normal economic and credit cycle where these issues would be coming into play even if we had not sort of adopted Dodd-Frank and other regulatory, additional regulatory issues. Because you get to a point where during a downturn and where banks' loan portfolios deteriorate. They deteriorate because the state of the economy is deteriorated. Even credit-worthy borrowers who were signed up originally, some percentage of them are going to go under. They're not going to be able to pay that back, and so the loan portfolio deteriorates. That's a time where the bank examiner comes in, and it's the bank examiner's job to protect the taxpayers' money, the insurance fund, which the banks are supposed to be paying for, but sometimes the taxpayer funds get inserted into that, right? So it's a normal time where there's tension between the bank regulator wanting to make sure that, you know, credit conditions are tight enough so that we don't get into more trouble and a bank teeters and fails. But we also, from a macro standpoint, want more credit to be extended. People who previously were credit worthy, if the customers come in the door and they can grow, that'll be a better situation. There's a normal tension. Now on top of that, we've got additional regulatory changes which take business models that worked quite well before. We've changed fee structures and things like that. Banks have historically bundled products for consumers, given away free checking, and nothing is free in this world, right? So you somehow have to recover those costs somewhere, and the way that they were doing that business model has changed somewhat. So I think that you know, one thing that's going to happen is every bank is going to have to think about this and find a way to deal with it. You alluded to exactly how they're dealing with it. I mean, they're raising capital, they're shrinking their balance sheet, they're not necessarily extending loans. Although when I do talk to bankers, they really quite uniformly tell me, and they do have a lot of funds, they would like to make good loans. There just isn't the demand for loans at the moment that they would like. I think that the biggest single problem that we have is there aren't enough customers coming through the door. The ones that are coming through the door at the moment are using their credit cards maybe a little bit more than ideally. If we could generate a little more growth, less uncertainty, get a little hiring, get more spending because there's more income in people's pockets, more demand, businesses will produce. I think we're just sort of not very far from getting that going. Especially if all of the regulatory noise and political noise were to die down and all of that. But that's a lot of ifs on the to-do list. Okay. I'm deviating from the ping pong back and forth structure.
It's been claimed that we must get out of the housing bubble before we can get an economic recovery. But is it not true that the housing bubbles don't really precede that? They occur concurrently as people's paychecks improve and their confidence improves. So that seemed to your primary interest, instead of focusing on the housing bubble, would be to focus on priming businesses. And it's been said that the reason banks, aren't lending is because long-term rates aren't high enough to provide the risk reward for making commercial loans at that level. So wouldn't that promote the business cycle better than wasting taxpayer money on trying to solve the real estate bubble?
Well, I mean, it's simply a fact that the state of so many financial portfolios is weak because housing values, commercial real estate values are low. If you could get those valuations up, then even without all of the things that you're talking about, the asset quality of the bank would improve, and they'd be in a much better situation, and they'd be able to make more loans than they currently are. Now, I suppose you're talking about the slope of the yield curve. At the moment, what we're doing, I would say, is we're providing liquidity so that the cost of short-term finance is very low. And to the extent that banks can find borrowers out there who are willing to make investments in the future, willing to go out and if it's build strip malls, if that's the appropriate use of it, or to expand their business, to build factories or hire more workers, they would need to borrow. What policy is doing is simply providing the funding for doing that. What bank loan rates are is whatever banks are able to charge, and in the current environment where some banks don't have the capacity to do that, I would think that banks could offer whatever the going rate is. And so I would say let the market dictate what that is, and banks are focusing on their earnings potential and getting their balance sheet right. Over here. Oh, yes, excellent.
We've seen a lot of economic stress when rates were very high as well as very low. Has there ever been a consideration within the Fed to keep rates within a somewhat rigid band and let the private sector figure it out?
Well, I thought the premise of your question was that market rates, like long rates, have been high, they've been low. So, I mean, that's the market dictating that will be. Well, I mean, short-term rates, I mean, the way to, Yeah, so I mean, you could go back to the 1950s, and before that, before we had the accord between the Federal Reserve and the Treasury, the Fed's job during World War II and in the last part of the 40s was to set the interest rate exactly what the Treasury said it should be in order to fund the government. You know, you can say what you will about those days and what growth rates were and what inflation was. That wasn't the best way to do monetary policy. The best way to do monetary policy is to focus on our objectives. Now, one of the objectives, I thought maybe you were going to ask this. When I say there's a dual mandate for maximum employment and price stability, sometimes people mention, you know, you left off moderate interest rates because the Federal Reserve Act does instruct us to maintain monetary and financial conditions to support all of the things I said, plus moderate interest rates. That is one of our objectives. We don't talk about it explicitly because, in my opinion, if we can keep inflation within the bounds that we think is appropriate, you know, interest rates are going to be some real interest rate component and some expected inflation component, plus some variability component due to all the risk uncertainty and risk premia. If we take risk out of the economy to the extent that the economy is growing pretty well, there have been periods where interest rates were like what you were talking about. I would say in the 1990s, that was the case where there was a very narrow band. The funds rate was between 5 and 6%, even when we were tightening. And the economy was growing. It was growing pretty strongly. And inflation was coming down, and it was well understood. So when you get the inflation component contained, when you've got the real economy doing what it's supposed to do, real interest rates will be contained, and then it just works out that interest rates will be moderate. If we're doing our job, it'll take care of what you're asking for. You could try to mandate and legalize that, but if you don't have the underlying circumstances of the economy, that problem is going to emerge in other places. Probably, if you do that, probably asset bubbles and things like that. So we're trying to meet what you're asking for. We're probably not doing the best job at the moment. I'm hopeful that we'll improve upon it. I don't know where the microphone is. Thank you.
Charlie, you talk about price stability in goods, but on January 1st, the price of a gallon of gas was $3.15. Today it's $3.55 in a week. It seems like the arrogance of the oil industry precedes themselves. Is there any way to regulate and control these fellows? Because they just don't seem to care.
Well, the way you worded that was more charitable than I expected. My daughter, my daughter, God bless her, graduated college a year and a half ago and is living at home with us. And she's moved from unemployment, she wants to be a teacher, it's hard to do that, to underemployment. She's an aide in a classroom. I'm ecstatic about that. But she notes everything that you just told me. So I have heard that before, and she says to me, "Daddy, can you get the price of gas down?" So it's not a monetary policy. It's not something I can do with monetary policy. It's a change in relative prices. I think that there's a lot of uncertainty taking place with regard to energy policy, energy pressures around the world, the global economy. A couple of years ago was stronger than it's ever been when you talk about emerging markets and billions of people coming online and putting more demands on resources, which as economists we know are scarce. So there's going to be price pressures. There's been price pressures on food. There's been price pressures on energy. When you build out a country as large as China and India and Brazil, it's going to put a lot of pressure on scarce resources. And so there's no surprise that there's going to be a change in relative prices. It doesn't feel good. It takes a bite out of our household incomes and budgets and all of that. Whether or not there's a regulatory component to that, I'm happy to leave that to other people who do regulatory matters. Where's the microphone that sort of usually dictates? Somewhere over here. Thank you.
So we're now entering the 5th year of recession-like conditions. It's been a long, long, long recession. When will it all end? When will this misery stop? And what will cause it to stop?
Well, my legalistic response is that the recession ended in June of 2009, but in fact, the recovery has been pretty weak, and so there is a real question as to how this will play out. I can't say I know the answer to that because I tried to get at that in my speech where I said, there are these two viewpoints. One is this could linger for quite some time. The 1930s were a period where things, lingering is not the right word because it was atrociously deep, and then we had some growth, but it was incredibly weak, and then mistakes were made. But, that was a horrible period. We've seen other economies go through that. Japan had a period in the 90s, and the last decade wasn't so good either. When you're down around zero for policy rates, that's usually indicative of something not very good. Milton Friedman said, you got to be careful in thinking about this. When interest rates are zero, that usually means policy is very tight. That in fact, you need to do more things because there's deflationary pressures, and that's all about monetary policy. On the other hand, it could be that there's something very deeply structural at work in changing the way our economy is running. I mentioned changing employment relations between workers and businesses over the last 20 or 30 years. That's a fact of life. Technology is changing. The skill requirements for jobs are changing. They don't change instantaneously, but over some longer period of time, those influences accumulate to the point where the next time you get to a point where things don't work out so well and you're in a downturn, all of a sudden you can't ignore some of those lingering issues. I'd like to be able to tell you that our most recent policy actions were just enough in order to get this economy going, along with a commitment on the part of the people in Washington to stop playing around and solve some problems that need to be solved. I'd like to tell you that. I'm not sure that's the case. We might have to do more. I think we should do more. I would much rather get the economy going strongly, even at a cost of slightly higher inflation than most central bankers would like. I think that's, as I look at how you value our mandates, we're doing woefully poorly on the employment side, and we're not really doing that great on inflation, but it's certainly low. If you were going to, balance these things out a little bit, you'd be willing to do that. So I'd like to come back next year and say we're not going to be looking at this going forward, but I can't say that for sure. In the center, we haven't done that.
Thanks for being here, Dr. Evans. Question is, thanks for being here, Dr. Evans.
Sure.
Kind of playing off that last question in your answer, God forbid that we need QE4. What's QE4 look like?
Well, I think we've only had 1 and 2.
Well, it depends upon what we... Okay. Then what's 3 look like?
Well, that's okay. I mean, in September, the FOMC took an action which we refer to as the Maturity Expansion Program, but everybody else calls it Operation Twist and that. I think that if we, like I say, I will stand on Milton Friedman's analysis, which I believe to be true. When short-term interest rates are unbelievably low, down around zero, and the economy's not performing very well, the way he would say it is, and when prices aren't increases, when there's not nominal expansion, that indicates that there's still very tight financial conditions in place. I think that if we could get to a point where we had more accommodative financial conditions in general, the transition would be much better. QE2, QE3, QE, whatever you want to call it, I think more accommodation is the right way to do it.
Question over here. I'd like to express my appreciation for your coming also. Much of what you've talked about has dealt with the national economy. Could you tell us a little bit about the Midwestern economy, your district's economy? And particularly, I read something yesterday about the decline in the value of the euro and its impact that it could have on our exports.
Yeah, so so in our region, the region that I have is the better part of the states of Illinois, Indiana, Michigan, Wisconsin, and the entirety of Iowa. Manufacturing is a very strong component in those states. And so we're overweighted in some sense relative to the nation for manufacturing, which means that our Midwestern region, when times are good, they're very good because manufacturing is that much more volatile than the economy, but when times are bad, it's that much worse. And so we've suffered through that. I would say that is the first thing to take note of in our area. And we've certainly seen that with the auto sector. There you've got the structural problems that they had not dealt with over a longer period of time, and then you had the bankruptcy and the issues there. But now they're back to a better situation. Light motor vehicle sales are on the order of 13 million. That's well down from the heydays of 16 million, but that was a totally different business model, I would say. So things are doing better. Industrial production has been stronger. Now in the metropolitan areas and in Chicago, obviously business services are critically important. Chicago has a tremendous representation there. Legal services, accounting services, business services, and all of that. And that at some level is going to be tied to the region's businesses, again, manufacturing to a good extent, and also the nation. So to some extent, we've been following national trends, by and large, I would say. And then you have the transportation aspects of our region, O'Hare, the hub activity, and all of that, and the logistics that go with that, with the railroads coming through here. And again, sort of national trends are really kind of important. So, I continue to be sort of surprised. I moved here 20 years ago from the East Coast when I went to buy a house, and the real estate agent said, "Now I just got to tell you that this housing market's unlike any you've ever lived in before." And basically, her ploy was, it's like when you find a house you like, people pay the price. That's really what she was trying to say, which I don't think is exactly true, but. Basically, we haven't had the same kind of exuberant price behavior in the Midwest that you see in other places, and certainly not the hot markets. Although we did see pretty good price appreciation, but boy, we saw downturns in prices too. So I mean, prices in our area, I think they've fallen by about a third, which is about on par with what the nation has been. So most of our issues are the same as the nation. If we got the whole economy going in a better way, we would certainly benefit and ride along with that. I don't know if we'd lead it, but we'd ride along with it.
Thanks for your time. Since the downturn, I think most would agree that the Fed has been very accommodative and taken a lot, made some moves to do what it could, at least with the tools it has.
Yeah.
But there's another side of that. In previous Fed chairmans have been much more aggressive about communicating what they felt the government or the legislative side of government should do. Why haven't we heard more from this chairman about the state of the economy or what they can do from a legislative side? And because I think that the tools that you have are somewhat limited at this point, and I think a lot could be done. Even you have alluded to that.
Yeah, that's a fair observation. I mean, I've heard that from many people before, and it's a very difficult issue. I mean, first off, when you're in the business of making monetary policy, one thing that we find to be unbelievably important for us to do our job effectively is that we have some measure of independence from the rest of the government, and particularly political issues, political pressures. Now, I like to be a little careful when I use that term independent, because it sounds almost undemocratic, and that's not what is meant by this. There has to be enough distance between the decision making that we do and the political complaints and pressure, because it's very difficult for anybody to make decisions that require a long-term perspective and are painful, and most people try to put that off. And government, politics, all of that happens all the time. It's human nature, and so and accountability rests on getting elected. I mean, the people hold you accountable today, and if the problem is 20 years from now, people usually don't think about that. So independence is really important, and we would never want to appear to, the same point. We don't want to pry into the realm of politicians and the government and other areas who have accumulated the credibility, and they're accountable to their own constituents. And so we try to behave symmetrically to some extent. Now, it has been the case that Fed chairmen have opined about longer term issues. And sometimes that's been good, and other times, you know, it's gotten us involved in the political process where all of a sudden one party would say, see, Fed chairman endorses what we're saying, and the other party says Fed chairman shouldn't be involved in this. So it's a little delicate. Still, I would say that Chairman Bernanke has gone to Congress. He's gotten questions. Congressmen always ask them to opine on that because they'd like to have their project endorsed. And there have been times where he said, look, we have a fiscal issue that needs to be dealt with, entitlement programs. It's not necessarily the immediate issue of the deficit, but the medium and longer term deficit that needs to be dealt with. And I've heard him say, and I certainly agree with this, is it would be tremendous if we were able to deal and come up with constructive, fiscally appropriate solutions for these longer term issues, which, you know, got the debt down, but at the same time in the short term provided some stimulus to the economy. Because if we could get the economy going, however it starts, we'd get things rolling, and then certain things would begin to almost as if they paid for themselves. Certainly in terms of, you know, debt to GDP ratios. You get GDP going up and you don't distort debt, you know, those ratios improve dramatically and things like that. So focusing on the appropriate horizon is important. Chairman Bernanke certainly has made comments about Congress enough so that congressmen have said, you know, the Fed chairman shouldn't be getting in our business as much as he is. I've heard that from some senators in the press reading things like that. And just the other day, the Fed shared thoughts on the housing market, which Congress at various times has asked us for our expertise. If they were going to design new programs, and you guys know about housing, what do you think might help? There's a lot of interactions in terms of the expertise of our staff. You know, we shared that with the public, and you know, we were criticized by some people as saying, oh geez, you know, you shouldn't be involved in that because you're the monetary authority. So we try to be careful about it, but you know, on the merits, on the facts, if there's an analytical issue which we can provide insight on, I have a staff of economists and we have them around our Federal Reserve System, and we're willing to, you know, make our best research results available to anybody, and then it's for them to use it. 2 more questions, all right. My productivity is very high today.
Dr. Evans, thank you for coming, and more importantly, thank you for stepping out from the rest of the governors at the FOMC. My question deals with the too big to fail issue. Dodd-Frank has given some accommodation to the Fed to solve this, along with the other regulators. If we look in the rest of the world, we see Great Britain, the Bank of England, Chancellor of the Exchequer, forcing their large banks to get rid of thousands of branches and dramatically downsize. We see Brian Moynihan, CEO of Bank of America, saying that he's too big and that he has to downsize. When is the Fed going to get on this bandwagon and get rid of the 50 too big to fail banks that are well beyond their economies of scale?
Well, that's an interesting viewpoint, quite forcefully expressed. I appreciate that. So there are many things that you mention in there that resonate. Certainly, when you have financial institutions who are so large that either the regulator or everybody who's in a policy position understands that it's almost impossible to allow them to fail because of the add-on, knock-on effects to the rest of the economy and the world financial system, that's a problem. And it's a problem in part because anybody who extends credit to those institutions, right, all of their creditors take into account there's no risk involved. And so the prices that these institutions have to pay in order to acquire those funds is too low. The market is supposed to discipline that type of behavior when an institution is not performing well, when it's engaging in risky activities to the brink of putting the institution at risk of failure. Then they're supposed to, step back and take corrective actions before a regulator has to come in. The market's supposed to discipline that. But when everybody perceives that any particular financial institution is obviously never going to fail, they don't price in that risk. You get more behavior that's bad. You get more risk. When risk is too low, you get more risk. Okay, so we need to deal with that, absolutely. Dodd-Frank, I think, helps with that. At least before Dodd-Frank, we really didn't have adequate authority to take down an institution that was so large that it was into everybody's business and scattered around the world. Now we have greater legal authority to do that. Different institutions that were outside of our range now could come under our purview. So, that gets into systemically important financial institutions, which are deemed that way. There are proposals that institutions like that should hold more capital. So one of the counters to creditors won't price the debt appropriately is, well, they ought to have more capital because they're obviously more risky than their pricing suggests. We need to have things like that. But I don't think it's appropriate for the Fed or any government agency to dictate, or I'd be very reluctant to do this when you sort of say, you can't do that type of activity, or that activity is too big, or whatever. It would be better. It would be better if the private sector, the financial system, could impose pricing that gets at the equilibrium that you're talking about. If that's the best one, that would be best. Having said that, we do impose fiscal restraint on a lot of people, and I would say that the additional capital charges for SIFIs is one of those things that's intended to help out with that. I got one more.
How at risk are big U.S. banks to the euro, and what's the Fed's, what's your view of how the euro is going to play out in the next year?
So we have looked very carefully at the banking system. We regulate the big banks and all of that, and we have looked at it very carefully. I haven't been involved in that personally, but it's very important to know what their exposures are, what their liquidity needs are, what the maturity of their liquidity is, because in the event of some type of financial distress, is it the case that their liquidity could dry up? That would be a large problem. To the best of my knowledge, we're working hard at that, and we seem reasonably comfortable with the way that's playing out. I think according to certainly financial press reports, many people have reduced their exposures. Money market funds have reduced their exposures to the euro, and in particular certain countries which are under even more pressure in Europe. So I think everybody's taking the actions that they would like, that they need to take. In part, that's causing even more difficulty, right? Because that just amplifies when a country like Italy can't find funding for their debt, even though their deficits aren't really as large. They have a large debt, but they're actually running a primary surplus. It's the interest payments on their debt that cause the difficulties. And when people run from that, it makes the problem even more difficult. When they run from the financial institutions who are trying to get away from that, it just sort of amplifies all of that. So we're looking at that as carefully as we can, and I'm hopeful that the Europeans will continue to deal with this situation very carefully, because I think the euro, I think the European, I think that the euro has been a benefit since its inception, and it's important to maintain that. They're working very hard. I'm hopeful. Thank you very much.
On behalf of the Rotary Club of Lake Worth, thank you all for coming, and thanks again for Charlie Evans and his comments.